Beijing is grappling with a mounting debt crisis as investors ramp up calls for fiscal stimulus to boost the economy.
Enter the darkness of doubt as we examine the indications of a possible, stunning collapse of China's economy. Find out the crucial elements that might alter the dynamics of the world. While the rest of the world is grappling with rising living expenses, China is coping with the exact opposite problem: falling prices. The second largest economy in the world technically entered deflation for the first time in 2 years in July, when consumer prices declined by 0.3%. Prices have already stabilized for most of 2023, in contrast to the broader global trend of growing expenses for everything from energy to food. While consumers can find lower prices enticing, experts think deflation is bad for the economy. Prices fall for an extended period of time, people spend less, and firms cut output, which results in job losses and lower earnings. The country's economy's slide into deflation is the most recent in a line of cautionary signs that raise questions about the resilience of China's post-pandemic recovery. Although deflation has already occurred in China, analysts are more concerned about the current price decrease. Beginning in 2021, when prices last dropped, millions of people were under lockdown and businesses were shut down due to COVID regulations. China is presently regarded as being well on the way to recovery after eliminating its strict zero-COVID regulations in the latter half of last year. China's recovery hasn't exactly been a thrilling story thus far. Several financial companies have downgraded China's outlook for 2023, despite the economy's recovery from the pandemic's weak foundation, because they think Beijing won't be able to achieve its goal of about 5% without considerable stimulus measures. After suffering through excruciating lockdowns, Chinese consumers are still reluctant to spend money at home, depriving the economy of a vital boost in consumption. Chinese households are conserving more money than they were planning to spend. Businesses are investing and borrowing less frequently. While employment has been consistent overall, Beijing chose to cease disclosing data about the country's youth unemployment since it has increased significantly. As depressing as all of that may sound, it is crucial to remember that the economy is not collapsing. The gross domestic product of China is still predicted by economists to increase by 5.1% this year, 4.5% the next year, and 4.6% in 2025. In contrast, it is anticipated that the U.S. will expand by 2% this year, 0.9% next year, and 1.9% in 2025. Prior to the pandemic, throughout the first 19 years of this century, the American economy increased by an average of 2% annually. The trajectory of China paints a different tale. From 2000 through 2019, the GDP increased by 9% per year on average. Currently, it appears that China's growth is falling at around half that rate. That rate may decrease even more, given the plethora of difficulties that lie ahead, such as the massive amounts of debt and the growing aging population. On the geopolitical level, there will also be repercussions. Slower economic expansion also results in more moderate growth in tax collections. This suggests that President Xi Jinping's administration may have to make some difficult decisions when it comes to funding scientific advancement, dispersing wealth among emerging nations, and purchasing weapons that may tip the balance of power in the Pacific. The slumping real estate sector in China is currently the largest obstacle to the nation's economy. Property values are dropping, developers are defaulting, and the populace is irate. Beijing has been attempting to stabilize the sector by lowering interest rates and ensuring that builders can access finance. But so far, nothing has been able to reverse the trend. The most serious of the several issues that are endangering China's economic future is the property industry, which accounts for around 1/3 of GDP. Even when supply exceeds demand, real estate development is encouraged since local governments in China have historically relied on land sales as a source of revenue. As a result, there are more ghost cities of abandoned housing construction and pointless infrastructure. According to some estimates, the proportion of unoccupied apartments in the housing stock might reach a fifth in 2019. Beijing's initiatives to prevent overborrowing led to the large developer Evergrande defaulting on more than $300 billion in debt in 2021, exposing the market's flimsy roots. Since then, the crisis has had an impact on a number of other important developers, most notably Country Garden, which was the top developer in China by sales in the previous year and is currently sitting on the precipice of a $200 billion default, according to Christopher Bedore, Deputy China Research Director at Gavical Dragonomics. The way that Japan and China are similar is that there's an open question about whether they have been overinvesting and piling up a lot of debt. That means they will experience slower growth as a result of having to eventually pay off the debt. According to data by Gavical Dragonomics, 53 state developers were responsible for 174 billion yuan, $22.8 billion, of the overall debts owed by 86 non-state developers last year, which totaled 725 billion yuan, $99 billion. Beijing would almost certainly step in to stop the real estate market from completely collapsing. But other experts think officials may view the current situation as a painful but necessary corrective to China's reliance on construction-driven development. That is a risky strategy, and things can spiral sideways in that market very, very quickly, warned Bedore. And because of the ongoing question of whether or not they will save the firm, all these real estate developers keep appearing in the press. There is no doubting the dire state of the Chinese economy, and despite Beijing's pledges to strengthen the private sector and protect firms, these efforts appear to be failing. Data on the nation's economic activity for July portrays a troubling picture, with important metrics including retail sales, industrial production, and investment output falling short of forecasts. This has increased worries about a slower, more prolonged downturn in growth. Since the start of the second quarter, data pertaining to Chinese economic activity has fallen short of expectations, which has caused some major concerns, as seen by the trepidation in international markets. However, China's economy has experienced difficulties before. China experienced comparable shocks during the 2008-2009 global financial crisis and the 2015 capital outflow concern. But in both cases, the government encouraged infrastructure investment and boosted the real estate markets, resulting in a stronger Chinese economy. The economy of China might suffer greatly from the country's diminishing domestic demand, which will also make it difficult for the private sector to attract investment. Uncertainty is evident if we examine the economic climate in China. Will it survive the storm, or will it soon collapse? The future is waiting for your views, so get involved in the discussion and keep updated by subscribing to the channel.